Joining me now is Ken Hoffman, head of global mining analysis for Bloomberg. Ken, thanks for being with me.
Thanks for having me.
So you're a speaker at the show here at the Metals and Minerals Conference in New York. Obviously, you're going to be talking about mining stocks. What's your message to attendees?
Our message is, while things are very, very bleak, that the end could be near in terms of the bottom, and that the savior could come from private equity.
From private equity, how so, Ken?
Well, the mining sector has had a big problem in not wanting to hedge, and the understanding of wanting to hedge is something that I think private equity wants to do, because the mining sector is very, very short capital right now. Private equity is very long capital. Ben Bernanke and everybody in the world is flooding them with cash, but they need things to invest in. And so all of a sudden what they find in the mining sector is an industry that's been very deeply depressed. And then all of a sudden, the price of gold, even though it's come down a bit, you can go out and hedge it for the next 10 years, and here's a guaranteed cash flow. And that's very appealing to private equity funds. So much so that in the last 6 months, they've raised $9 billion US, and that's more than the last 4.5, 5 years combined.
Okay. So right now, what do you say to investors who are looking at mining stocks? Should they wait?
I think what they should do is try to figure out where will private equity companies look to invest. And historically, what private equities will look to invest in is they want properties that really don't have a terribly long life, that have good cost control. Because again, at the end of the day, what the private equity is going to try to do is to marry the revenues with that hedging with the cost. And if they can get a nice cost stream, that means everything for private equity. That's how they make money. And those are the type of companies that have a lot of interest to them.
Ken, let's back it up a few years now and let's look at when mining stocks started hurting. And it seems that it occurred with the advent of ETFs. Do you think there's a correlation there?
Very much so. I mean, we've seen more than 300 billion US go into gold ETFs alone. And what really happened was the people who are investing in those are people who normally really want to be in and out of gold, or a lot of hedge funds who can't invest in the physical gold, but they can invest in an equity, which an ETF is. And so by taking that 300 billion that normally would have gone into small cap, mid cap, large cap miners, all of a sudden what you saw was this money rushing out the door. That caused poor performance for these companies, and then all of a sudden, the people who were left, those long-term holders, saw worse and worse performance. At the same time, the S&P and the Dow were hitting all-time records, and so they started to leave these industries. And so you've seen a lot of the big mutual funds who have to be in this space just start to take all the money off the table because they're getting redemptions. And what we always say is bad returns beget bad returns, and we've been in a really bad downward cycle.
But ETFs are also hurting right now, and it seems those people have not switched over to mining stocks either, so everyone's just hurting, Ken?
Yeah, I think what they're doing is everybody's leaving the mining sector right now. Right now, it's just a free-for-all to get out the door. People are not believing in China when it comes to base metals. I think they're thinking, well, hey, the Fed has kept interest rates this low for this long. Maybe it goes on forever. And probably ignoring a lot of the fundamentals that really made a lot of sense a year ago.
Let's talk about lending rates for mining companies. I know this is a big factor or point you make in your presentation.
Yeah, right now, if you look at what's going on for the mining sector, especially the juniors, more than 40% of the small cap miner companies have less than 3 months of cash on hand. And we were over in Europe last week, and there you saw that only one debt deal has been done in the past 3 years in the mining space. And even in Canada, where there's been a few debt deals done, the mining sector has the highest interest rates of any sector out there, more than 600 basis points above what average BBB lending rates are. So it's this lack of capital, and I've heard as much as 50 to 70% of all junior miners will not make it through this downturn.
So those interest rates really hurting the mining companies. Ken, why are they so high? Is it just because of the risk associated with mining?
It is. There's a lot of fear about mining. Since there is no hedging that often goes on, you're looking at the downside. The majors have fired all their CEOs. Pretty much everybody's gone. And those companies are selling assets. The juniors are out there looking for financing. Well, it's not going to come from the seniors because they're out there selling assets, and there's no real buyers. Even the Chinese have stepped away at the moment of buying these assets. So it's really problematic right now for these small cap companies.
Finally, Ken, I know you have to be neutral and you can't tell me whether you're bullish or bearish on gold, but can you tell me and explain to us a little bit about the bullish case and the bearish case for gold?
The bullish case would be, we've ran some numbers on the cash cost for gold. And for the majors, it's about $1,200 an ounce. And typically you won't see the price of gold drop very much below that because all the mines will shut down. So that's one bullish case. You look at the Japanese yen, there's something going on there. There's something about depreciating your currency, so-called, Jim Rickards always calls the currency war. And it's going on now. I mean, what's going on in Japan is a true currency war. Look at the Chinese currency hitting all-time record highs against against the U.S. Dollar, well, at least over the last 15, 20 years. There's a lot of currency stuff going on in the market. At the end of the day, what I think helps that is gold being back up there as a value and a store of assets.
Ken, thanks so much for your thoughts today. It was great speaking with you.
Thank you for having me.
And thanks for watching our coverage from the Metals and Minerals Conference here in New York. We'll have more for you. In the meantime, you can email me any comments or questions at newsfeedback@kitco.com or follow this conversation at my handle on Twitter at Daniela Cambone. Thanks for watching.